Hello, hello. Welcome, everyone, and thank you for joining. I'm Lauren. I lead Fintech and stablecoin partnerships over here at Utila. We are the wallet infrastructure layer that lets fintechs, banks, and payment companies hold and move stablecoins at scale with the custody, governance, and controls that institutions need. Today's conversation is about one of the most interesting things happening on top of that infrastructure: embedded, risk-managed on-chain yield. I'm joined by Mike from Gauntlet, Senior Protocol Strategist. Gauntlet is one of the leading risk curators in on-chain finance. They design and manage the risk frameworks behind billions in vault deposits, and they're the expertise layer that turns raw DeFi yield into something a regulated fintech can actually put in front of its users. Mike's going to walk us through how that actually works. Also, Gauntlet and Utila recently published a joint report, DeFi Yield, a Moat for Digital Asset Treasuries, that goes deep on this thesis: why staking alone isn't enough anymore, and why curated vaults are the next frontier, and how the risk management and custody layer fits together. The report will break that down. It's a good companion to today's conversation. We'll cover a lot of the same ideas today and share it during the webinar and after, so you can dig into it. Mike, I'll let you take it from here, and I'll jump in with questions as we go.
Well, thanks for that wonderful intro. And yeah, happy to dive in and happy to be here in general. I'll give maybe a quick background, quick overview, and it maybe even leads into a history of where we are today and how we've arrived in this sort of regime, which I think we're all very happy that crypto, blockchain, stablecoins are getting widely adopted. But yeah, I've been in crypto every day since 2013, so it's been quite a journey seeing how it's evolved, and it's wonderful where we are and seeing how many different people around the world are actually adopting this, from retail to users globally to institutions. So it's really great to see that. And, back in my journey, I was studying computer science at college and first learned about Bitcoin, and it took a little while for it to click. And I realized this is something important, something big happening. When Ethereum launched the ability to have smart contracts, and you started seeing these first iterations of money markets and collateralized debt position stablecoins like MakerDAO evolve, and the iterations we've had since then. So it's been really interesting seeing how far we've come. And we're not the degenerate yield farmers anymore. They still exist, and they still drive up a fair share of borrow demand, but we are really seeing this becoming institutionalized. It's becoming quite a nice product, something that you can fit in, make it really easy for users. And we can talk about, what that looks like for users, how they can access money markets, lending, yield, and even, what some of these next trends are, and where I think that's going and where we're seeing that going. So happy to dive into that. Going back from the very beginning days. So, I did DeFi strategies for a living for a while, and I ran a small consulting business, kind of helping, guide people on their money market decisions, teaching them how to actually borrow on chain, get yield on chain. And some people wanted to go a little bit deeper and really explore yield in these strategies. There's a lot of different avenues for this, and there's a lot of different places where the yield comes from. And that's always a question: where does the yield come from? Mm-hmm. How does that work? And then happy to talk about how we at Gauntlet we do due diligence, how we look at these different yield sources, how we actually curate a vault, and how we think about this experience as we manage risk. And, Gauntlet's been around. It's the longest running DeFi risk manager and quantitative firm in crypto. And, when I started my journey on the governance forums trying to run yield strategies, I bumped up against Gauntlet and saw that there is people actually running these real legitimate models and simulations. And it was pretty eye-opening for me compared to the risk management I was doing on my own, which was nothing at all, to be just a finger in the air. So these early iterations of lending protocols, they allowed you to over collateralize, crypto. So, something like Ethereum, something like ETH, and later other assets. People would have different use cases. And so I like to say, DeFi does have real world use cases. And, it's less and less that I have to convince people now than I did maybe 4 or 5 years ago. A fun story, though, that I like to tell people is I actually used the DeFi loan to help purchase my house. And so there are real world use cases. And, being an early crypto person and just a total believer, when it came time to purchase a house, they said, all right, let's see what you got in your bank account. Well, I'm holding everything in crypto and on chain. So, but, showed them my portfolio, and they weren't very impressed. They didn't quite understand. So they said, sir, you're going to need to sell your crypto before you buy a house. Said, okay, what do I need? I just need some financing. I need cash to show proof of funds. And they said, sure, that's all we need. So I went on chain. This is back in the MakerDAO days. So collateralized my ETH, borrowed some stables, swapped that into USDC, and was able to show proof of funds. So this was some real financing that, I was able to do on chain. It was rapid. I was able to get my funds in there instantaneously. And it was really eye-opening for me personally. And I'd used it for similar use cases. But, seeing this come to life, and these are stories that I had other people. So I was running Bitcoin and Ethereum meetups in my San Francisco house. And people would see that you could actually use financing in a real way to do real world things. And I think that was eye-opening for a lot of people, a lot of these early people. And I think today people are beginning to see like, hey, we have the ability to do this, whether you want financing, whether you want just to earn yield. And I think yield is probably the easier place to start for most people. People can understand that. And so, there's people from the retail side, there's people from institutional side. They all have different use cases, different levels of education. But I think the place that everyone can start is yield, earning yield. And so, if you have stable coins, you have idle funds sitting in a wallet, and if they're not doing anything, let's utilize them. Let's make it more capital efficient. And this is where we're seeing some of these more product rich yield applications, plugging into these markets. So, happy to talk about that. So just a bit of a background and catching us up to now. So it's I think we've really entered a new regime, and it's exciting to be here and see institutions coming in. We're seeing banks come in. We're seeing that, as I don't want to get too, idealistic here, but, we are seeing, with AI, things are moving fast. Technology is moving fast. Society, the way they incorporate technology, the way we incorporate technology is moving fast. And, as we move towards a more global, and if you want to use the Kardashev scale, like a type 1 civilization, but as we become more global, more digital, it seems pretty clear that there's a new infrastructure emerging, and it really does allow for these wonderful components these are the reasons why people kind of gravitate towards crypto, towards these rails, which I think right now it's great for financial rails. I think there's going to be other great applications, but it gives you this level of transparency. You can verify, so the age old term, verify, don't trust. So, we are seeing this global framework, and we are seeing that the world does need to have this sort of global digital substrate that can plug everyone in. The internet grew really fast, and I think there's, maybe a lot of reasons why we didn't see these money protocols, money markets, and more deeply ingrained finance within the internet emerge. I think it's maybe some of these reasons. I think there's a lot of other reasons, and maybe this isn't the place to get into that. But we are seeing that, you do have this concept of DeFi Legos. Everyone's heard about the DeFi mullet. And so this is what we're seeing institutions. This is where we're seeing people plug into and realize that they can access these sort of modular money components on this digital substrate and really open up a lot of great features for their users, for people that are looking for, whether it's yield, whether it's someone who's just new to, having an account balance and actually earning some yield on that. So I think, we are seeing I hate to say it, a new paradigm, and it's really exciting. So
we're moving up the Kardashev scale, as you mentioned.
Yeah, and maybe we're not ready for Dyson spheres just yet, and I actually think that's a funny idea anyway. So we won't get too into that, but so I mean, I think we can look at what where we are today and what that's doing, and we are seeing stablecoin adoption go mainstream. It's no secret that the United States it's been very welcoming to that. We're seeing users all over the world, and we're seeing people come in from different countries, people that don't have access to dollars, people that want to maybe spend in one other currency and save in dollars. We have people that, where they sort of skip some of this banking infrastructure, and so they have the ability to actually plug in and have the ability to earn yield and have this, this newer framework for yield and financing. So it's moving fast, and it's I could definitely be happy for it to move faster, but I've been waiting for this for over a decade, so it's great to be here. But I mean, you look at some of these numbers on screen. It's just they're increasing every year. We're seeing this take over, and so really it's really moving in here to the next level. Let me see if I can switch my slides here.
Yes, should be able to.
Let's see. I'm not having the ability to.
We'll get it done in the background.
Okay. Well, we don't have to really stick to the slides so much anyway. But let's see.
Well, there we go.
Okay, great. So, it probably is worth talking about what this stack looks like and, where this is being deployed. So like I mentioned, we started off with something like MakerDAO, collateralized debt position. And, what this is, and it still works the same way, where you have some collateral, you lock this up and you take a loan out against that, and you're paying some sort of interest rate. And this can be, it can be, today it's mostly a variable rate. In some of the early days, it was maybe quasi fixed rate. It wasn't pure fixed rate. On the maker days, they would vote and, through governance and change the rates from time to time. Then you saw something like the next generation emerge, which is where, we saw Aave come in and compound. And, it introduced these variable markets, multi-collateral markets, and, the ability to onboard different types of collateral. We did see that, it still was going through governance. It still was slow. The process to do that was a little bit clunky, and the ability to have fast, rapid, risk on movements if you do want to, de-risk and move out of a market. There's limited risk controls in these early iterations of money markets. Then, Aave started introducing this concept of isolated pools where you could have isolated capital. So you're not exposed as a lender to this entire broad basket of collateral types, where some might be, let's call it more blue chip collateral. So like, ETH, wrap staked ETH, whatever you want to call it, and or wrapped BTC, to going more down the, if we want to call it the degenerate scale or the risk scale in terms of what types of collateral. So these sort of isolated buckets did allow more granular approach to where you're getting your yield from. But again, it was still going through governance. It was still slow and clunky. The feedback mechanism, the feedback loop was a little bit slower. So in terms of managing risk, you only had the ability to move so fast. And so now I would say, maybe at a third generation, if you want to call it third generation lending protocol. And so this is something like Morpho. And so this is completely permissionless, doesn't have to go through governance. You have the ability for someone like Gauntlet to curate a vault. And so, this is what curation is essentially the ability to define these vaults. And a vault is one asset that you're lending out from the lending side, and that essentially gets lent out. And so there's a variety of borrowers, a variety of collateral types. And, based on this risk profile, we'll have different buckets that we can consider, in terms of extremely low risk, medium risk, and as you go up the risk and the reward scale. But this allowed curators or allowed risk managers to have really rapid feedback loops. You could construct these custom vaults. You could have different risk profiles. You can do custom vaults. You can do a lot of really cool things. And I'll even talk about some of the interesting things that we're seeing institutions come to us today and ask about, in terms of, overnight lending facilities, supporting these, like supporting a margin exchange, supporting other financing needs, even doing, tokenized receivables, tokenized lending balances, real world assets, obviously is a big buzzword. So we're seeing a lot of these elements come on chain. There is, and it's, while a lot of the stuff is open source, it's difficult to go and engage and understand what is the risk you're taking? How does one approach this? And the number one thing is, we want to make sure, hey, as a lender, your money is safe, and you have liquidity. And so these are the things that are important. So Morpho's been great. I mean, it's, you have these super liquid markets. You have the ability to construct these custom vaults and have these custom experiences. So it's been a great platform to build on. And, this is why we're building on Morpho. And as you can see, Morpho is just growing rapidly in terms of deposits and size. So, going on to the next slide, so we can look a little bit about what the on-chain yield looks like today versus some TradFi benchmarks. And it's funny because, what we say today could be very different tomorrow. And that's, I think, one of the benefits and one of the things people like about DeFi in general is it moves and iterates so rapidly. And you do get this level of transparency, but, we will see in certain times. So, today, we're looking at, if we look at the national averages for savings, they're pretty low. So, I have friends that, hold dollars in a bank account, and they said, hey, I'm not getting any yield. And I think people are so trained to not get yield, they're not even thinking about it. They're not thinking, oh, I should actually be getting yield, or like, what's actually happening with my deposits. Once that light bulb clicks, they say, wow, okay, like the yield is actually really low. Why don't I hold stable coins, and why don't I get exposure to some of these different yields and these higher yields? And, when the DeFi, when the market in general is risk on, when we're in the middle of a bull market, DeFi moves so fast, and these arbitrage strategies are rippling throughout the DeFi ecosystem. You can see very, very different variable rates. And I think those are some of the rates that attracted people in the first place. When we do see markets cool off a little bit and people are becoming a little bit more risk off, we see those settle down towards, something like T-bill rates. And we do see these yields going, floating around there and above, depending on the level of risk one wants to go into. But, so, we have this treasury rate, we have these high yield savings accounts, which can be, up to 5, sometimes capped, sometimes higher, sometimes they're hard to get access to. And so that's another reason why these yield strategies are wonderful. It's not only is it transparent, not only can you verify it yourself, but it's open and accessible. So the barriers are dropping. So you don't have to be anyone special anywhere in the world. You can get access to this yield and plug it into a stack. So that's a great thing. And it's funny because, some of these yields that we were seeing in DeFi, they would get pretty ridiculous. So, I'm not sure how in tune everyone here is and what we've seen, but, I remember when Ethena first came on the scene, it was essentially running a basis trade, so a carry trade on perpetual futures. And essentially
what's the
took,
yield on that?
it gets pretty high actually. And we, at Gauntlet, we were even running some internal delta neutral strategies ourselves across different platforms. And, the APY spikes you would get on that from running those strategies, I mean, they can go over 100%. They don't stay up there, but they can. And, you have people on these perpetual futures platforms, and essentially what they're doing is their time frame to trade is typically a lot shorter than a lot of other margin exchange. So most people aren't on a perps platform holding long-term positions. Some people do, but the funding rates are so expensive, it's really hard to hold a long-term position. And, you're seeing leverage that is pretty wild. When I talk to some people and I say, yeah, you can get, 25, 50x leverage. It's pretty wild. And I definitely don't recommend touching that level of leverage. It's pretty crazy, but people love to gamble, and it's almost like a gamification of finance that you're seeing. And, it is drawing in a different crowd, but, people, when they're doing these ultra high leverage trades, they're holding them sometimes for minutes, so, maybe hours, maybe days. But as you go down that time scale, it's less and less people holding these positions for longer. So they're holding these short-term positions, and they're paying a funding rate, and they're essentially borrowing. And they are happy to pay these super expensive rates because, again, if you're looking at, hey, I'm only borrowing for 8 hours or 12 hours, I don't mind paying 100, 130%, because it's only going to be, a couple bucks or whatever, a small fraction of your size. And so, this allowed someone like Ethena, people were running this strategy. Ethena was the one who just tokenized it. So, people are running this strategy, and, they're paying these high funding rates. So there's a way where you could essentially run this delta neutral strategy where you essentially, you go short on one leg and you go long on your spot. And, with Ethena, they're also taking advantage of the ETH staking yield to add a little additional layer. But essentially you have this delta neutral position where you're earning the other side of that funding rate, because that's how perps work. Essentially, if the market's long, then shorts are paying longs are paying shorts, vice versa. And so you can essentially take that opposite side of that trade, earn that yield, wrap it into a nice little package, and you produce this, this great basis trade. And so when Ethena first tokenized this into their stablecoin, what happened is, you saw these lending platforms, all the other stablecoins, all the other rates that you could get, it was such a rapid rise. And for lenders, it was great because you did see, even on platforms like, Morpho, Aave, doing more basic lending, you were seeing rates, they were pretty high, above 10%, sometimes above 15% shortly. But so you're seeing these really, really high rates. And because essentially what was happening, and this is, how yield is derived in a lot, and this isn't the single source of yield, but it's just kind of a glimpse into the yield where people were very happy to pay and borrow, any stable coin they could get at any lower rate, because essentially you could plug. So let's just use USDC, for example. You could borrow USDC at maybe 5 or 7%. You could go swap that into Ethena's USDE, so their stable coin. You could stake that and then get exposure to that yield over there. And so as long, which was 20, 30, 40%, depending on when you got in. And so people were very happy to arb that difference, that spread. And so you would see, hey, if it's paying 20, 30%, whatever, that started pushing rates up very high. And so this is also one of the great things about, and especially Morpho as well, is it's so elastic, so liquid, and that you'll see the ability for people, if there is an arbitrage opportunity that's on the market, that quickly gets in and gets filled. And so we saw exactly this. So for borrowers, it was tough. You'd see rates go up 15, 17%, very high. And so you would have people that would really look to manage their borrow and maybe refinance their debt and go down to different platforms or go into different chains, because even different chains would have different rates, different ecosystems, or they might be a little less elastic in terms of how quick the rates would rebound. And this is all based on people doing arbitrage strategies and, taking that borrow side. So the reason I'm saying this is the reason that people got interested in DeFi Yield is I think still exists. We're in a more of a risk-off market right now. We are seeing more stable rates, so in the 4 to 5% range, and maybe the conservative range, medium to higher risk, 5 to 6%. And you can go down that spectrum if you want to, but you do get exposure. You leave yourself exposed to, less liquid collateral assets, and it's just a broader risk spectrum. And so that's something where we do see a lot of people, they tend to want to stay in those lower risk tiers, and they're fine, getting 5 or 6%. Mm-hmm. It's, 10 times what or maybe 20 times what they're getting in their bank account. So, but this has been a great way to sort of plug in this easy yield and kind of not have to think about the risk, because if you're an end user, it can be intimidating getting on the blockchain, trying to figure out, especially today, there's so many different collateral types. You look at some of these, tickers, and they get so long and they're wrapped in another protocol, et cetera. And, you kind of want to have this curation. You want to know, hey, I want someone else to do the due diligence, do the risk management. I want to make sure that I can basically just kind of set and forget. And that's what we're seeing today in a lot of these platforms. So whether it's like PayFi, whether it's like a credit card that plugs in on chain, whether it's a savings account or, an earn program, people want to have this ability to set and forget and just kind of plug into that stack. So, moving on to the next slide, I think this goes a little bit into, why this is so attractive for fintechs, for different players out there that have users that, are plugging in any sort of, into any money stack or financial rails. So, you want to have something that's simple to use. So, even on the wallet side, I think the journey maybe starts with, it obviously starts with a user, but it starts with an asset. And it starts with a wallet, and this wallet allows you to, it is a portal to the blockchain, and people kind of forget that. And, when I was kind of educating people early on, they'd say, oh, like I have this wallet, I have that wallet, my money's over on this wallet. It's like, no, your money's on the blockchain. The wallet is just the infrastructure. It's, the lens, and it's your portal to access the on-chain economy. And when I would frame it like that, they'd say, oh, okay, wow. Now I understand, like the wallet is the most important. It's such a powerful part of the stack, and it's very important. And, we've seen wallet infrastructure become very, very sophisticated and really take away a lot of these kind of scary UX issues from users. And this is why we've loved partnering with Utila, because it sort of extends that UX and allows just this plug and play ability to access not just the blockchain itself, but this on-chain yield economy. And so making that user experience, just abstracting all the scary things away from the user, making it easy. Having a user that just has this idle capital, when they can see idle capital and when they see that yield come in and tick up, it's a pretty magical moment, I think, for everybody. And, I think more and more young people are starting to, open their eyes to this. You talk to mom and dad, and, they're like, hey, we got our CDs and our bonds. And, but you talk to a young person and they say, hey, I have this money that was just sitting around doing nothing. Now I can buy, I'm earning a coffee a day, or I'm earning, my gym membership, then they start to get interested. And then they start to say, hey, like, what more can I do with this? And how can I grow my stack, Yeah. And so this is a great way for if you have a user who has money on a platform, just allowing them to just plug and play and earn this yield. Not only is it fun for them, and it creates a sticky user experience, it's just a great tool to have these users stay engaged. And acquisition is tough, and retention is maybe even tougher. just for any business. And so, having something like this where you abstract everything away, you have the ability for people to access yield, to access earnings on their idle capital. It's a really fun thing for them. So the last piece as well is, as I mentioned, part of that abstraction process is abstracting away like this decision-making tree, like where do I put my money? Is it safe? What's happening? And if you were to go into these money markets as a first-time user, I mean, it's you wouldn't know what to do or where to park it. It's scary, it's intimidating. So, having the ability to go in and through like a curated experience and say, hey, like, okay, I'm putting it in the Gauntlet vault. I'm putting it in the lowest risk, a prime vault. This is, it's set and forget. And that's, I think, what a lot of people want. I think today the story is about yield. I think tomorrow the story is going to be more about what other kind of financing. And so today's lending. So when I say yield for the end user, it's lending. So earning yield, going beyond staking. I think tomorrow it's going to be going to the borrow side. And people are going to see that magic that I saw when I said, oh, wow, I can actually get financing super rapidly, super easy. But not even at the end user. I mean, even institutions come in and they say, hey, like we have these overnight facilities. We want to be able to maybe tokenize these lending balances. We want to fund and kind of grow our book. There's a lot of different ways you can mix and match these DeFi Legos. So I think this stack is important. So what we're seeing on screen. So, you have this risk and curation. So just like I mentioned, so we are taking away the decision tree, the mapping, understanding, all the minutia of this, because it's at the end of the day, you still have an over collateralized lending position as a borrower. You're lending into these various markets, and so you might not know where to go and what to do. And so just taking away, abstracting this process away. So it's the risk and curation angle, and I can go into a little bit deeper on what that looks like. But essentially, on the curation side, it begins with a due diligence and constructing this vault that has certain collateral types. What we're looking at on our end is, so we have this infrastructure. So we essentially look at a lot of parameters, but just to distill this down, the one thing we want to make sure is that we have very liquid markets, and these markets stay healthy and over collateralized. And that's the job of ultimately the way the lending protocol works is they have to have a over collateralized position. And so what happens is when there's a borrower, who a user is lending out to, that user is putting up their collateral. So let's say their staked ETH or their wrapped Bitcoin as collateral. If their position becomes unhealthy, so their debt to collateral ratio, if that debt increases to a certain point, this is when someone's eligible for liquidation. And this is how all these lending protocols work. Now, there's various parameters. So the number one job is we want to make sure that these positions can be liquidated in a healthy fashion, so that there is a liquidation path, that there isn't going to be slippage, or that we're calculating what that slippage is going to be, and making sure that there is just always a healthy market. And so this way, lenders can always just really have this set and forget attitude, because if you don't go through a curator, then this is something you're going to have to manage on your own and look at these things and think about these things, whether you're on the lending side or the borrow side.
Oh, sorry, Mike. I was going to say that is a huge point that you make in these slides. Fintechs don't need their own quant risk team, which is huge. So yes, sorry to interrupt, but
no, the more the better. I mean, so it's like, having in-house risk team is like good luck finding people that have been in crypto long enough that are going to understand that. So that's one thing that's hard enough, but really even being able to plug that into a product and actually managing that, and then managing the risk on chain, because the on-chain world moves fast. So you have to be able to move fast as well. But that's, what goes with having like a best in class risk intelligence stack. So you essentially get that in a box, which is pretty nice. And I can talk a little bit more about what that looks like a little later. But yeah, the next step is having this vault execution on your behalf. So, whether you as a fintech or you as an end user, as a fintech, you might say, hey, I want to even start looking at spinning up maybe my own custom vault. I want to have a vault maybe for KYC users, for users that are, maybe there is some sort of gate, maybe there's some permission, maybe there isn't, maybe there's certain rules that you want to define. Maybe there is a custom way that you want to interact with these money market and lending protocols. Well, now you can have this execution, and this is what a curator is going to do for you as well. So, whether it is a blended strategy, whether it is a custom bespoke strategy, or whether you're even trying to explore the concept of maybe even tokenizing, some part of your own like financial stack and exploring ways to, grow your book. There's a lot of ways to do that. So, vault execution is just the ability to simplify interacting and engaging with this on-chain yield economy. And then, you have the custody and governance, which, I mentioned earlier, the wallet is the entry point for this whole thing.
Yes,
so
the portal.
It is the portal. So it's the most, it's the most important stack. It's the place where everyone starts. And so you do want to have something that makes it easy, that has sophisticated infrastructure that allows you to sort of plug into this stack, which has been great. So like if you are in Utila, you can actually plug in, you can, with the flip of a switch, enable these vaults. You can come talk to us as well and say, hey, I've been using like your, off the menu, off the shelf vaults. We want to do something more bespoke and custom. You can come talk to us. And then that's another flip we can switch on inside Utila. So it's very, very cool. And so maybe going on, leading into the DeFi mullet. So yeah, and maybe mullets will make a comeback on the head, but it definitely sure is in the stack here. But no, I love that term.
Me too.
It is. I think it's the sort of blended step before we enter this. And if we're gonna go to this Carter Shop scale, this type 1 civilization, this is the kind of old school, new school. This is where they meet in the middle.
Mm-hmm.
And so I think I don't think anything is going to change people wanting to have a simple experience. It's when you have users on your platform, you want to make sure that it's easy, that it's intuitive. You want to abstract away all the thinking. Like you want to make sure that they're there and they can do what they want to do, what they need to do, and that they're engaged and they're going to stay sticky customers and users. So, this whole concept allows us to have, this very complex on-chain economy, plugged into this whole DeFi Lego stack. And I think when, the decentralized, DeFi summer was a fun time, and we started seeing it was the best. I kind of wish we would go back to some of those times, and it was a little degenerate, and I learned some hard lessons myself. But it was so fun, and seeing the whole emergence of this concept of a DeFi Lego. And I think this is also what really opened up people's eyes to this whole concept of, this new digital framework that we're building here. Like you have the ability. So, when I was, going to school for computer science, they taught us, one of the first things they taught us is, hey, when you're writing code and building software, you want something you want to have elegant code. You want to have something where you reuse your code. You want it to be an easy to read, easy to build on top of, and you want it to be elegant and beautiful code. And when you get into the real world, if you go to Y Combinator, it's like, hey, we want to get to market as fast as we can. Mm-hmm. And we want to sort of throw all these processes out the window. Speed to market is important. And so I think the internet grew a little bit faster than the infrastructure and the underlying stack was ready. And you saw this stack where you have middleware on top of middleware on top of middleware. And it becomes very vulnerable to security. And I think this is why one of the many reasons you didn't see finance rails really emerge on the internet, and it was very, very gated. And, I know in my old software days, trying to get anything done within a financial organization, or healthcare, similar thing.
Oh,
It's
God.
so slow moving the guardrails. And you also had this concept of credible neutrality, which is also, I think, a big thing. So, having the ability to, and I'm going to come to the credible neutrality point, but, having these DeFi Legos. So having the ability to reuse code, have elegant code, and build on top of this stack is so important. And we saw so many interesting financial instruments emerge this way. And it was amazing seeing how fast DeFi, this young, new on-chain economy, really replicated every sort of financial instrument you can imagine, and then invented financial instruments that never existed before. Like a flash loan, for instance, which, when I explain how a flash loan works to my uncle, it completely blows his mind. And this is something, going into what keeps a market healthy and how these markets are liquidated on these lending platforms. It is through one of these new financial primitives called a flash loan. And if I'm going to talk about it, I might as well describe how it works really rapidly. But essentially, what it allows anyone to do is like a penniless hacker, and maybe that's not the right word, but someone who's let's just say, who wants to run an arbitrage strategy that doesn't have a serious bankroll. Anyone off the street, a kid out of college, a kid in high school, even, it's crazy how rapid people are developing these strategies. But essentially, they can come in, they can take an uncollateralized loan of any amount, and what a blockchain allows you to do is it has this concept of atomicity, and I'm sure I'm saying that wrong, but essentially, yeah. It allows you to build a transaction. You can interact with multiple DeFi Legos all in the same transaction. So you're taking a loan, okay, under like an uncollateralized loan, you're penniless, of infinite size. You can do swaps, borrows across different DeFi Legos. And the condition is that in the same transaction, you have to pay back your loan plus interest, okay? And so in this atomic transaction that is just a stack of all these different instructions to swap this, do this, pay this back, as long as you fulfill that requirement that you're paying back your loan and you are paying that interest, everything executed, and you're able to run an arbitrage strategy. And there's a lot of use cases for this, and it didn't really cost you anything. If any part of that atomic list of transaction fails, then the whole thing reverts and it's like nothing ever happened. So you have these properties of a blockchain that are special, that allows you to do and build these new financial instruments. And so this is how liquidations occur in a lot of cases. There's a lot of other strategies, but I guess the point is that you have this ability to run these DeFi Legos, build on top, and build really, really interesting solutions. And not only are you building, potentially new financial primitives, but you're also building something that allows you to access just some of the basic core concepts of money, just like earning yield or getting financing. And you expose this in a very simple and abstracted way. And this is what the DeFi Mullet kind of brings to the picture. And I think I might have even gone down a track. And I would say, one other thing too, this whole credible neutrality component, and I think it's probably a buzzword in some communities, but it's a very real thing where, which is also why I think we're seeing this new sort of financial stack and all these primitives and this whole digital substrate take off. And this future global digital economy is that you have the ability for independent actors to come to a neutral place and build on top of these Legos and interact. And you're not essentially paying some sort of fee to your competitor. You have places where two competing organizations or companies can come in and build together. And so that's why I think we are seeing this new on-chain economy emerge. And why I think it didn't happen in the early days of the internet. So it does go into, that ability to have these elegant, nice Legos you can build. It does come down to having this verifiability. I don't even know how you say that, but the ability to verify what you're doing, this transparency, but also this credible neutrality where you can actually come in, You can engage with other parties. And I think, if we even take it a step further, what we're going to see with like zero knowledge proofs is, the ability to actually engage with counterparties that could be your competitors. You don't know, and you're not revealing any information. And so you're having this level of anonymity. So I think it's just, we're headed in a direction that it's going to unlock a lot of powerful features and primitives. And I think I don't think it ever changes where you're going to have users where you want to abstract away all this complexity, package it to them in a nice, simple, familiar way. So users don't have to see, understand what's happening under the stack, understand, doing the gas, understanding rebalancing these, not a portfolio position, but this vault position where you're earning your yield. And then, all these liquidation mechanics, like I mentioned. So maybe moving on to the next slide. So we do have a vault for every audience, and what this means is it can be the level of sophistication or education your users have about what's going on under the hood, or these yield sources, or their appetite for risk. And then on one end of the spectrum, you might have someone that, maybe they are educated, maybe they do know, but maybe they say, hey, I don't want to have to think about this, and I don't want to put any risk of, maybe it's not their funds, maybe it's like a custody solution. So when we see this prime, so this is going to be your blue chip collateral, very low insolvency risk. And this is something where your collateral is something like ETH, BTC, wrap stake ETH, and this is something where, I, as a borrower, I'm typically engaging in these markets on this side because I'm holding these blue chip assets. This is what I'm using for collateral when I borrow. When I was running DeFi strategies for a living, then I would go down and I would be the other counterparty to some of these, maybe these frontier, these models. But so prime is something where it's hey, this is where you're going to plug in. You want to have ultra liquid markets. You don't want to have liquidity crunches. You want to have instant liquidity available immediately. You want to have low insolvency risk. So this is just a little bit safer, or this is a lot safer than some of the other ones, but you have the ability where you are going to sacrifice a little bit of that yield. You move up that spectrum, you can get a little bit more of a higher blend, a little bit higher yield, and you still have a large exposure, a primary exposure to a lot of these same blue chip collaterals. And then we sprinkle in some of these other collateral assets that are still liquid, maybe not ultra liquid. So we're not allocating heavily to them. And so this is what this construction looks like under the hood, where we do have certain rules and we have yield optimizing automation that happens, but we have these rules that we stick, that we stand behind, where it's there's going to be a certain amount of collateral that is blue chip, and maybe just small sleeves of these other collateral assets that, based on what the liquidity looks like, based on what the market looks like, slippage, these things, we'll rebalance in and out of those. Then you have people that say, hey, I don't care, I just want yield. I still want to work within a relatively safe framework, but I'm open to going further out on that spectrum. And that's what Frontier is going to be. And that's where we will have higher exposure to some of these other less liquid assets, less lindy. So maybe some that haven't been around super long. And so this is something where these are usually yield bearing assets, or maybe RWA, real world assets. These are maybe, Pendle PT tokens. So this is something where you will see people who, from the borrower side, if I'm running a certain strategy, I might want to collateralize some of these more exotic assets, and I'm willing to pay a higher rate because I'm earning a higher yield during my strategy. And so I'm happy to arb that spread and pay a higher rate. So you have this blend. I would say a lot of people do stick in the prime or the balance categories, and it does depend, institutions pretty much entirely on prime. Some people let their users choose, kind of give them the information, let them choose for themselves. We can do, and then, seeing down below, we do have a step above that. So within Gauntlet, we've incubated in-house this protocol called Era. And what this allows us to do is to have this sort of meta structure on top. And so essentially it's a protocol, and it's protocol and vault agnostic, and it's chain agnostic. And what it allows us to do is to actually access Morpho and these underlying yield strategies. It has the same core concept. It's plugged into the same risk intelligence stack. And what we can do is essentially run these optimizer strategies where we're essentially looking for whether it's like the highest stablecoin yield within bounds. And again, we're not going too far down the spectrum. Like safety and risk mitigation is still always number one. But we have these vaults that can actually allocate into on top of other vaults. So it's sort of like a meta aggregation strategy. We also are able to run leverage looping trades through that as well. So we have RWA vaults. We have just very basic where you can collateralize an RWA, borrow against it. A lot of people who are doing this, they're actually looping. So someone who's coming in, so you might be able to take a stable coin. You may be able to mint a real world asset with that. What's happening with that stable coin is a lot of cases it's going into maybe like a special purpose vehicle. And then that allows a company, so maybe they're growing their loan book out and they can grow it really rapidly. And so what they can do is they issue this RWA, which is like a claim on that underlying. And so you can collateralize that RWA and you can borrow more stables against that. And you lose a little bit of capital efficiency each loop, but you as the looper, you can go in, run this loop a few times, and you can really sort of leverage up what you're getting on that underlying yield. And so this is great. So for the user, the strategist, they're able to leverage up, get some leverage of their choosing on their yield. For the RWA issuer, this is great because it allows them to grow their book. And so they're very happy to do that, and it allows it to grow a lot faster. For a stablecoin issuer, it actually grows their supply as well. So they're happy. It's sort of a perfect marriage. And so this is where a lot of the yield comes from on the borrow side. And then there is an appetite to say, hey, like, what if we just wrap this strategy? Maybe we do light leverage, or you can maybe select some leverage. And so we do have our AIR protocol that will actually allow depositors to come in and deposit into, a low leverage, relatively risk mitigated looping strategy. So there's some cool stuff there that we have brewing, and I invite you to come on the website Gauntlet XYZ and look. We have, like I mentioned, bespoke vaults as well. So we have partners that will either be, maybe they're onboarding their own asset, maybe it's a stablecoin issuer, maybe it's an RWA issuer, or maybe they just have a custom profile of assets that they specifically want to curate to. So that's where we can build these bespoke vaults, and this is sort of that vault access in the prior slide. So there's a lot of cool fun things to do here as well. So and this is interesting as well. So just some proof points. So I see a lot of institutions come in and they say, hey, can these markets handle size? Like, we're going to throw $1 billion in here. Is it going to compress the rates? Is it going to compress the yield? And so we had this is such a wonderful stress test. So we did a pre-deposit campaign. In a single transaction, we absorbed $775 million into two of our vaults. At the time, it was a 40x increase in the vault TVL, but we were able to work with our Rolodex of borrowers. We were able to onboard new collateral and essentially meet these lenders and make sure there's borrowers to come in and have the ability to arbitrage. And it's wonderful that it's so liquid and so elastic. So we saw that deposit happen in one transaction. We did naturally, of course, you're going to see yields compress, but they fully recovered to that whatever that market level was at the time in about 10 days, which is pretty phenomenal and amazing. So the answer is like, it can handle size and it can handle absolutely ridiculous deposits in a single transaction. Now, we would obviously recommend staging this out, but it can happen in one transaction. Cast is another great example. So 500,000 users. It's essentially like a money app. It's like they have a credit card, they have spending, and they have the ability to earn yield. So essentially allowing users to take that idle capital and earn yield on it. So just increasing capital efficiency. But I know I just looked at the time. I do want to give time for any questions. I know I just kind of went off the rails here. So
no, it was fantastic, Mike. I don't know that we have any live Q&A, but just to close and wrap this up, maybe a good question would be like, if a fintech in the audience wanted to start exploring this, what's the realistic first step? or what should they not do? Feel free to answer.
Yeah. I mean, come talk to us. Yes. If that's the best place to start, come talk to us and let us know what you're looking to do, what your user archetype is, and then we can help you plug in. I mean, essentially, it's a lot of people are trying to earn. The dominant theme is how can we earn on our stable coins? That's where almost every conversation starts. But we are happy to take it a little bit further and go into a more sophisticated discussion. But no matter how simple you begin, everyone starts from somewhere. So you don't know anything until you learn it. So there's no bad place to start.
That is a great way to end this conversation. I again appreciate you, Mike. This has been a treasure trove of expertise and info. And in the background, Mike, I think we may need to have you host another session on how to buy a house.
Yeah.
Because retail investors, fintechs aside, I know there's a lot of aspiring homeowners out there who love to learn from the master. So
let's bring DeFi to the real world. It's time.
Yes. Again, thank you so much, Mike, and look forward to hosting you for more in the future. And again, hopefully, I think our contact info will be dropped. And thank you so much again for your time today, Mike.
I had so much fun. Thank you.
Good. Yay. All right. Thanks, everybody.
Bye.
Bye-bye.